Hi, Bob.
Hi, Bob.
How are you doing?
I'm doing fine.
Well, you're one of the few people who is today, probably. Things are kind of grim in the financial world. Thanks for taking the time to talk to us. We've had a number of people on to talk about the financial crisis. I think it's safe to say you are the most imminent. You're a professor at Yale, and you are, first of all, author of the famously prescient book about 8 years ago, Irrational Exuberance, which was a bestseller in which shortly before the dot-com bubble popped, explained why it was about to pop. And now, with equally good timing, you are the author of the Subprime Solution, an admirably short book. It's the kind of thing you could read during a single sleepless night while worrying about your portfolio. So I'm really happy to have you on and to explain to us the fundamental causes of the crisis we're in, which is what this book is about, and it's also about kind of long-term structural solutions to I guess prevent the next train wreck. I wanted to start out before we get into this book by asking a question that touches on the irrational exuberance idea, which is just that. I guess you would agree that at this point, with stock markets plummeting, and I should say we're taping this on Friday, it'll probably air on Monday, irrational forces have set in, even if some degree of wrenching adjustment was originally a rational response to some ill-advised things that were done in the housing market?
Well, I would say that both rational and irrational forces are always at work in speculative markets. The way I would put what's different is that we have a focusing of attention on the market. This is one of those days when people will stop you on the street and say, "Did you hear what's going on in the market?" The same as in other market crises. And so it brings everyone in, and all kinds of decisions are being rapidly made, some rational, some irrational. But the essence of it, I think, is that time is being sped up, and that people are getting to making decisions that they've been maybe thinking about for months, and now they're doing it.
Yeah, and they're starting to do it, are they not, on the assumption that maybe the stock market decline will just not stop for a long time, right? I mean, just fear is driving a lot of this, right?
Well, one thing that is really significant is that people are talking about the Great Depression as if it could happen. Mm-hmm. I've been inclined to bring up the Great Depression in my macroeconomics lectures for all of my career, but it never seemed real, and I wouldn't claim that it was imminent. Most people thought it couldn't happen again. Now they're changing rapidly, and that change represents a major shock to confidence, and I believe it's a shock that won't go away for some time.
Yeah, when I've been saying for years, how do you know the Great Depression won't happen again? And people always say, well, we learned so much about what we did wrong, and I always say, yeah, but the environment is so different now, the technological environment, and it's a much more kind of intricately globalized market, even if it was a globalized market to some extent in the 1920s, and who knows what lessons we actually haven't learned. And I think what's going to happen this weekend is interesting, and of course people will be viewing this after the fact, but you're going to have 2 meetings of global leaders, and I'm wondering, first of all, what your expectations are, but also whether, to some extent, what we're going to learn is that we need to have more in place in the way of global institutions to deal with crises like this, or is that not your view?
First of all, going back to what you said at the beginning, in 1929, people said, we've learned a lot. There was this 1907 crisis, and we reacted to that crisis, and we created the Federal Reserve System, which was designed to prevent this sort of crisis. And some people back then likened the Federal Reserve to the governor on a steam engine. A governor is a device that regulates the steam engine so that the boiler doesn't get over-pressured. It lets off steam when the pressure gets too high, and it allows the pressure to build up when it gets low. So that was an engineering analogy. So it was clearly thought in 1929 that we had figured out how to stop this kind of thing. And I think you hit the nail on the head when you say that the situation is always changing. And so we've entered a new phase in the economy that is not adequately controlled by this 1913 institution, the Federal Reserve.
Mm-hmm.
And then you were moving on to something about whether we need global coordination.
Mm-hmm.
Well, that sounds like a good thing, I suppose, but I'm not overly convinced of that. Recently, a couple of days ago, the central banks of the world announced coordinated rate cuts of 0.5 point.
Mm-hmm.
Now that sounds very coordinated, I guess, but if you look at the starting rates in these different countries, they're very different. Mm-hmm. And so you have to ask, well, what's the point of doing a coordinated rate cut? I suppose it has some psychological significance. It looks like we're cooperating, and I guess that's a good sign.
Well, yeah, and if you believe that at this point the main immediate problem is trust and confidence in the system, there's something to be said for sheerly symbolic things, right?
Oh, that's right, yeah.
Let me ask you, what are you hoping will come out of these 2 weekend summits? I guess we've got on the one hand, G7 leaders, and on the other hand, we've got, do we have both IMF and World Bank meeting as it happens this...
That's this weekend, yeah.
Well, what would you like to see? I mean, I think it's kind of 2 days of opportunity for somebody to do something that convinces the world to calm down. What are you hoping will come out of all of this?
Well, this relates back to themes that were in my book. In the first stage, I think that we have to maintain a sense that justice is served.
Mm-hmm. And this is your most recent book you're talking about, the Subprime Solution, right?
That's right.
Okay.
That we have economic institutions that, while they may have to be abrogated at times, we have to do that with a plan and limit the extent that we do. We have to treat people fairly. And issues of fairness are cropping up again and again right now. When you bail somebody out, there's always somebody else who's not getting bailed out. And it sounds like madness. And this sense of chaos is part of what's driving the confidence problems. The other thing is that I think that, in my view, the really important things is to keep a sense of long-term plan for the financial sector, that we have to have a plan to make it work well in the long term, and that we're not shutting down the financial sector. All these things I put under the heading of democratizing of finance. We have to make sure that finance works for the people, and that the financial markets are redesigned to function well, to promote the welfare of our world's people.
Okay, maybe this is a good time then to step back and begin with your analysis of what went wrong here as you presented in your book, and then lead back to an elaboration on what you've just said, what kinds of solutions you see. Now, here's what I think I know about how we got into this mess, and tell me where I'm wrong and where I need to say more or whatever. But so we went into a period when it became very easy to get a mortgage, for starters, okay? There was a combination of lower down payments and also these credit terms that seemed very attractive, even if in the long run they could come back and bite you, these teaser interest rates and so on. And so that created a situation where, first of all, you had some homeowners who could potentially default should things turn south, and moreover, the ease of getting the real estate accentuated the tendency for this bubble to develop, and thus increased the likelihood of ultimately things heading south. and meant that, once they headed south, there were a lot of vulnerable people. And then, aside from that, there was this so-called securitization of mortgages. This new way in a new process in terms of what happens to a mortgage after you take it out. In other words, it's no longer the local bank you got it from that actually owns the mortgage. This securitization process and these derivatives and so on. So, my vague idea is that all of this is somehow at the root of this. What would you add to that or subtract from it?
Well, everything you said sounds right, except that I would say I would trace back the roots even deeper. And I think the reason that we had negligence in our issuance of mortgages, and the reason we didn't have regulators who were clamping down on that, and the reason that securitized subprime mortgages were accepted blithely by the market without worry, is ultimately a more deep-seated cause, which is a sense of complacency and optimism that was driven by a bubble. And it's something that has developed actually over decades. One way of viewing it is that it's a little bit like wars. Historians say that when a nation has a nasty war, they are war-weary and they will avoid it very hard for another generation or more, but then eventually they forget how terrible a war is, and they start doing provocative things that makes it happen again. I think it's similar with depressions or economic contractions. We start to think that those things can't happen anymore. We also start to think that we have a get-rich-quick scheme that develops from rising financial markets. And that, along with the complacency, caused people to take riskier and riskier positions. And the economy becomes more and more leveraged and more vulnerable to counterparty risk. More and more people are taking it for granted that these big financial institutions are invulnerable, immortal, and they're as good as gold, and they are willing to disregard what might happen in a big catastrophe.
And I think it's your view that, to some extent, bubbles, which are one manifestation of the forgetfulness you're talking about, grow in a way kind of naturally out of human behavior. It's the reason we keep seeing them. It's not just forgetfulness. It's not only that part of human behavior. It has to do with hope and greed and whatever else and following the herd. But I think it's your view that bubbles will kind of naturally happen. And so is it also your view that they will naturally happen in the absence of regulatory structures of certain kinds? And that's the way we should approach the process of regulation?
Right. I think that regulatory authorities have seen it traditionally as their mission to restrict bubbles. But our complacency has grown to the point that they started to lose sight of that mission. And so our Fed chairman, Alan Greenspan, although he once said that he thought he might have seen irrational exuberance in the market, generally believed in the efficiency of markets. There was a huge intellectual revolution that came in the, say, roughly the 1970s, which led economists to think that markets are perfect. This was very contrary to earlier views that emerged from, say, the Great Depression. Fed chairmen used to come out and warn people that the market was speculative and use their moral suasion to curb it. Moreover, they used to regularly adjust margin requirements. So when they thought the market was getting too speculative, they'd raise the margin requirements. That last time that happened was in 1974. It began to be thought that there's no point. The markets are perfect.
So in terms of blaming people, and By the way, in my experience, just as a pedagogical device, it's easier to explain to people what went wrong if you do associate the mistakes with individual people, because that's another part of human psychology, is people like to know who gets blame and who gets credit. You would blame Alan Greenspan, at least in part.
Well, I didn't mean to single him out.
No, we'll get on to the rest of the culprits. We'll go through the complete police lineup here. Don't worry.
But the thing is
you put some blame on him.
People, the one human tendency that's been noted by sociologists and anthropologists is that people tend to defer to authority, and there's an instinct for authority. And the guru-like status that Alan Greenspan cultivated led to an attitude toward him that, as if he was, godly in his wisdom.
Well, I remember.
And moreover, institutions. We believed Merrill, Lehman were great institutions, and forgot that it's just a bunch of guys, trying to make money.
And Greenspan was, I think, not irrelevantly, basically, he came out of a libertarian background, right? A kind of...
Yeah, if you read what he wrote back in his early days when he was a disciple of Ayn Rand, he sounded rather radical, conservative. He came around to a more nuanced view when he became Fed chairman. But I think still his instincts were to respect successful people, assume that, as Ayn Rand said, that she talked about economic heroes. So there was a thought that the economic process singles out and selects the smartest people, and we have to let them do their great works without interference. That's Ayn Rand talking. It's I think, a really exaggerated view, but it's also a view that easily goes along during a bubble period when all these people are making money and are presumably geniuses.
Mm-hmm. Okay, and what should Alan Greenspan have done? I gather one thing is to adjust the margin requirements, and then.
Right.
And then also, should there have been some more hands-on regulation of derivatives, in which he had great faith? There was a recent article in the New York Times about how much faith he had in the derivatives that seem to have led us down this path. Is that somewhere else he should have been active?
Well, I think all financial markets need regulation. But one of the themes of Subprime Solution, my book, is that regulation should be constructive. That is, it should look for the strengths that these markets offer the economic system, and derivative markets do offer very important strengths. So we need to regulate them only to make sure that they work properly. And so I'm in agreement with Greenspan on that. I believe that the extension of derivative markets represents economic progress. It represents risk management, and that's, in fact, I would say that this crisis cannot be blamed on derivatives. It's rather more to be blamed on the lack of development of our risk management. Look at what was the core cause. It is individual homeowners defaulting on their mortgages. Why are they defaulting? It's because they were put into leveraged, undiversified portfolios with their life savings. They're in a terrible situation because they've gambled everything on real estate in one city, and they borrowed to do it. How this came to be the enlightened wisdom is kind of amazing. But that is the real problem. It's not the derivatives that's at best secondary.
Okay, but my vague impression is the following, that one consequence of, and I couldn't define a derivative to save my life, but my sense is that these derivatives are part of the process by which ownership of the mortgage and the risk assumed by the person who extends the mortgage, or the ownership and the risk came to be extended kind of all over the world. Certainly well beyond the community of the person doing the buying of the home. And my sense is that was one consequence of that, maybe I'm wrong, is that the people deciding to extend the mortgage to the home buyer were not any longer the people who are going to pay the price if their judgment turned out to be bad and the home buyer turned out not to be able to make the payments, right? I mean, I have this idea that in the old days, the Jimmy Stewart days, local banker comes up, sizes comes out, sizes up your prospects, and has a very strong interest in getting it right because he or she is on the hook if you don't make your payments. And am I wrong to think that these derivatives were part of the process by which that sense of responsibility got kind of diffused?
Yeah, well, this is a problem of complacency, that people thought they had these credit scores and other scientific methods of quantitatively evaluating mortgage pools, and they thought that they had the problem solved. So that's something that we have to work forward to improve, and I think we can. We don't, but we still want to see the risk spread. That's ultimately the way we achieve diversification and risk management. I was just saying that we are living in a situation where the risks were not spread well at all. The holdings of U.S. subprime mortgages by foreigners was an example of risk spreading, but it was only among a small number of portfolio holders who often leveraged themselves up. So they weren't following, and the homeowners themselves were not following good investment advice.
Yeah, no, that seems safe to say, and you think that was the root of the problem.
As part of national policy. And there was a reason. The U.S. government, starting in the Great Depression, very actively subsidized home ownership. And the form of the subsidy meant getting people into risky, undiversified, leveraged positions in real estate. Mm-hmm. And there was a theory why we should do that. The theory was that home ownership promotes a sense of good citizenship and belonging, and it's good for society. I think there's indeed some truth to that. But we've lost in the shuffle the problem that we are creating such a risky position for people. And so I think that's one thing that we have to turn to now to get a long-term solution to this problem that has just gotten so ugly.
Okay. Now, are there other, in your book, The Subprime Solution, as you analyze the roots of the problem, are there other parts of your analysis that bear on the debate that's going on right now about who is to blame? I mean, we've talked about Alan Greenspan, but there's this larger debate about, was the problem, broadly speaking, too much regulation or not enough? Was the problem repealing Glass-Steagall, which had created a wall between commercial banks and investment banks? Was the problem the push by Democrats in particular to get more to make more low-income people eligible for home ownership? What are the other suspects? How does the analysis in your book bear on the current attempt to allocate blame in those realms?
I don't know. I think that this desire to allocate blame is much overdone. It reminds me, after any major war, there's a tendency to want to blame the losing side. And after World War II, we had war crime trials. But remember that in their enlightenment, they decided to limit that to a few senior people, because most people in any country are just caught up in the situation and you can't really assess blame on them. And it's the same in an economic situation. And so, who should we blame? I think that really it's a social situation that generates the blame, and there's nothing that we can. I don't think that focusing on sending someone to jail is the right focus. First of all, it's destructive to do that, because these financial institutions have purposes and have points. So I don't think that that's the right way to go. What we want to do is to get things working well. We want another new deal that gets fixes the problems in these institutions and gets us going again on a new financial infrastructure.
Okay, elaborate a little on some of the solutions that you think are in order.
Well, first of all, I think we need a better information infrastructure so that people can acquire enlightened views. Secondly, we need better markets that allow us to manage risks and actually spread them more. See, this is where I'm opposite of what you're thinking. I think we need more derivative markets. that can function to hedge risks that were not properly hedged in this example. And thirdly, I think we need new retail products, like notably better mortgages. But each of these things represents a revolution of sorts. That I'm not talking about incremental movements. I'm talking about major changes. Mm-hmm. So should I start with one of those? Or
So would part of the solution be to encourage, you said that the risks were improperly hedged. And right. I mean, they must have been because, although derivatives in theory diffuse risk, which is a good thing, there's something about this situation that made the risk, in fact, contagious. And and so I gather you think part of it is to end or curtail the improper hedging of risk. And is there a way that the government can encourage the more enlightened hedging of risk? Is there a specific solution there?
Well, the thing that comes first to mind is that I believe we should change the fundamental mortgage institution. We have a mortgage institution now that puts homeowners in a leveraged position, and that encourages them to concentrate their risks on one city. So a continuous workout mortgage, as I call it, is a mortgage that has built into it a workout of the mortgage. The word workout is not, some people don't know what that means. If you can't pay a mortgage today, suppose you get in trouble and you're missing payments, and your financial advisor will tell you, you should talk to your lender. So you go into your lender and you say, look, we're having trouble, we have all these bills, we can't make ends meet, we can't pay it. Then the builder, the mortgage originator, may say, okay, we'll give you a workout. We'll lower your payments, or we'll even lower the total amount owed. And the mortgage originator does that out of self-interest. Sometimes, if the mortgage originator thinks that the costs of evicting you and foreclosing exceed, the costs of the workout. And so generally, Congress and the President have tried to encourage workouts, but they're not planned for in advance. So the very first step is that if we recognize that there are economic circumstances where widespread workouts are a good thing, we should plan for them. They should be in the initial mortgage contract.
Okay. And that's a matter of federal regulation?
It's not really a matter of regulation, because it's not against the law to issue contracts privately like that. It's more an issue of coordination. And so I think what the government has to do is analogous to what it did to create long-term mortgages in the 1930s. So let's remember, every crisis is different. What was happening in the 1930s? Then the standard mortgage was a 3 to 5 year mortgage that had to be repaid at the end. It wasn't self-amortizing, which means that you would pay interest every month, and at the end you'd pay the whole thing back. And nobody thought you could do that. You had to refinance every time the mortgage came due. And that obviously didn't work in a huge financial crisis because home values had dropped and they no longer qualified for a refinanced mortgage. And a lot of people were out of work, and so by that reason they wouldn't qualify. So the government then created the Homeowners Loan Corporation in 1933, which not only refinanced mortgages for troubled borrowers, but also insisted that the mortgages be 15-year and self-amortizing, so that you would pay a constant amount each month for 15 years, and at the end, there would be nothing more to pay. Mm-hmm. And so that is now a standard. The government didn't force this standard on the country. It didn't make a regulation, except that it said that the mortgages that it refinanced would be of this variety. And that was a fundamental change which lasts to this day. Most people today get self-amortizing fixed-rate mortgages. Now we're up to 30 years or sometimes even 50 years. But the industry was not about to, I guess there was experimentation with that in the 20s, but it was not about to offer these on a large scale until the government got behind it.
So in this case, would you want the government to use like Fannie Mae to similarly kind of exert leadership?
Well, it could be Fannie Mae. It could be a new homeowners loan corporation. There's many different forms it could take. But the important thing is to get the government behind a mortgage lending standard that manages risks. And the way I think of this is really democratizing finance. Companies manage risk. They will make derivative contracts between each other that manage risks. Let's do that for individuals. Well, it doesn't have to have the kind of systemic problems that we've seen in some derivatives. It can be merely just a contract with the mortgage originator that there's a workout at a certain... Now, one problem that makes workouts very difficult today is that they didn't even anticipate this. And so they had maybe some provisions for some kind of steps to take when a mortgage borrower can't pay. But they didn't plan for a big crisis like this. And now they've spread out, they've sold off these mortgages to residential mortgage-backed securities, and then these securities are divided up into tranches, and those are sold to CDOs, and they're split up in different ways, and then the CDOs are repackaged into they call CDO squared, and so on. All this was done without adequate concern for how we would work out these mortgages, because now the owners who might have to give permission for this are scattered all over the world.
Right.
So you really have to design it so you don't have to go back to those guys, so that you can just follow through the contract that will take into consideration this kind of collapse.
Well, isn't that an example where the structure of the securitization and/or the derivatives was part of the problem in complicating a workout?
That's right, but ultimately, the reason why we had that problem is not because derivatives are bad or that it was bad people who were arranging the derivatives. It was because that people thought that this situation couldn't happen. And they were in a bubble mentality, that they were thinking that the important thing to do for all these mortgage borrowers is to get them into this galloping market, get them into the bandwagon. We're doing them a big favor. And hey, the details of this mortgage, they don't matter. You know, I think people really believe this. That's why I'm not putting blame on mortgage originators. They really believed that they were doing these borrowers a favor. So even if a poor immigrant family who hardly spoke English is put into a subprime mortgage with a low teaser rate, they still believe they were doing them a favor, because they thought, well, okay, the rate's going to go up in a couple of years, but, you know, hey, if they don't want to pay that, they can always just sell the house, and they'll have made so much money on the appreciation of the house that they'll be happy they did it anyway. That was the thinking. That's bubble thinking.
And that is going to be part of our future experience eventually, right? Complacency is going to set in again. So, I mean, you do have to put structural solutions in place in the long run, because human nature itself is not going to change, right?
Right. Well, I think our thinking about financial markets is evolving a lot because of the advent of behavioral economics, which is, I think, the most significant revolution in economics and in finance of the last couple of decades. We're now starting to think about human nature and not rely exclusively on models that assume that every single person is calculating and maximizing accurately. They're not. We know they're not. And we have to then start thinking about how to design financial products for real people.
So are there other major parts of the solution you lay out in your book, The Subprime Solution, that you have not haven't talked about yet, that you want to talk about?
Another one is, and this may sound like the opposite of the trend that we're getting to, but I think that we need to broaden our derivative markets. We have to do it right so that it doesn't generate systemic instability, but we want to broaden our derivative markets so that it allows people to manage risks, big risks, that matter to people. This is democratizing finance again. What I mean by that, let's consider real estate. It's the biggest asset class. Recently it was $20 trillion in the United States. That's single-family homes. Bigger than the whole stock market. Spread out widely over many people. and very illiquid and hard to trade in. So there was no way to hedge this risk. So I've actually been involved for years now trying to improve the management of real estate risks. We created, my colleagues at my company, Macro Markets, and I worked with the Chicago Mercantile Exchange and with Standard & Poor's, which now publishes the Case-Shiller home price indexes that we developed, to develop futures markets for single-family homes. And we now have futures markets for 10 U.S. cities, and also for an 11th market for the aggregate of the 10 cities. And with these markets, it becomes possible to manage real estate risks in a systematic way.
So if I participated in the market, I could, bet that the real estate market in Chicago will go down over the next year, for example?
Well, you could, and you can. Chicago is traded today. You can do this. It's not hypothetical. However, futures markets are sophisticated markets, and I don't think that most retail homeowners will get into them. Instead, I think that companies will offer products that are risk managing for homeowners. So what I would like to see is what I've called a continuous workout mortgage that will guarantee to a homeowner that if your home price falls, your mortgage payment will fall too, and your mortgage balance will fall too, so that you're protected, so that you won't get into this negative equity situation where your mortgage is worth more than your house. So that it would be continuous, that every month your mortgage payment would be adjusted, so that you never get into a negative equity situation. Then you ask, how can a bank offer such a thing? That puts risks on the bank. And that's where the futures markets come in, or other derivative markets. We have to be able to protect the bank, or the mortgage originator, the mortgage holder, from the risk that home prices will go down. And so ultimately we put that in another market and spread it all over the world.
So that's where the futures market comes in. It means that the bank can, in fact, in some sense, however indirectly, place a bet on the market falling, so that if it indeed has to adjust downward what it's going to be receiving from the homeowner, it will have as compensation the fact that it won that particular bet, in a sense.
That's right. Well, that's hedging. The general public is not very familiar with hedging, and that's a problem, a political problem, because they tend to associate futures markets with gambling. But actually, futures markets, well, there are some gamblers who play the market. Futures markets are actively used by businesses to hedge their risks, and they could be used to hedge the risk of writing mortgages that help protect homeowners. That's why that's the message of my book, that I want to think constructively, to think of finance as a technology. And let's get away from this idea that we have to rely on some existing institutions. The institutions we have are all malleable, they're all changeable, and we have to think about the ideas behind them, how they work, and how to make them work better.
So I guess you would say, my perception had been that in some sense, look, a fair amount of hedging goes on anyway, and in fact that is part of the revolution we've seen in home financing, is that as these mortgages get securitized and their ownership gets spread around the world, there's insurance policies taken out. There is a fair amount of hedging, and my impression had been, and I think you're going to tell me this is wrong based on what you've already said, but that the links in the chain of hedging and securitization turned out to be the links by which the disease spread around the world. So
right.
It seems to the naive observer that the very kinds of structures you're recommending the proliferation of were actually the avenues of transmitting the virus, and I guess you're going to tell us that's because it was done badly or something, if it's even true that it's the case. But
let's consider that. The way risks have been managed in many cases is for two financial institutions to make a swap between them. And this is not traded on any exchange. It's just a swap between two parties. For example, there's a credit default swap would be an example. And later, if one of the party wants to get out of this swap, he can't just go and sell on the market because he's got a contract with another party. So what they would typically do is make an offsetting swap with yet another party. And so the combined swaps cancel each other out. But they only cancel each other out under the assumption that both parties are living up to their side of the bargain, both counterparties. What we're seeing now is a failure of the counterparties. Once you have a whole web of contracts, once you have this web of contracts, the whole thing is vulnerable. Now, I have actually a very specific alternative that I'm working with my colleagues at Macro Markets to propose, which is that we create exchange-traded risk management contracts that are traded on the stock exchange. So we can create a contract that's based on some economic index, either long or short the index, which has absolutely no counterparty risk, and it can be used as a hedging vehicle. So, for example, we have had oil contracts that we think should be very useful for people. People in countries that are not oil rich, they should buy oil, and it should be part of their portfolio. So we wanted to make it possible to put a share in your portfolio that represents a barrel of oil. And there are other people who are overexposed to oil risk. And so we wanted to have it possible for people to put a share in their portfolio that represents a short on a barrel of oil. And the whole idea is to balance your risks. So oil is another example of a risk that hasn't been managed well. If you manage these risks, they don't bite you.
Okay. So you've talked about kind of your solution at two levels. One, insulating the homeowner from risk, and kind of relatedly, insulating the ultimate mortgage owner from risk, or risk insulation down the chain of securitization. Both of those things you think could be improved. Are there other major parts of your solution that you haven't talked about?
Yeah, well, another thing is I believe that we have to get financial advice to more people. Some kinds of advice that were known by financial experts were not getting through to the general population. Now, I wasn't including in that the idea that we're in a bubble, because apparently many financial experts did not perceive that. But even beyond that, though, there was some ideas that I think were widely understood that didn't get out, that would have been helpful to get out. One of these is that adjustable rate mortgages could be a big problem when they reset upward. Very simple reasoning. The Fed in the around 2002 to 2005 had very low interest rates. The federal funds rate got down to 1%.
Right.
And so that made the teaser rates on subprime mortgages very low, and you can be pretty sure that those rates are going back up. So any expert could have warned someone that you better be careful getting into one of these mortgages. But I don't think that many people who don't even know what the Federal Reserve is or what the federal funds rate is had a clue about that. Right. And they weren't getting the message. So I think we need to subsidize financial advice, democratize financial advice, and get it out there more.
Well, how do you democratize it?
Well, there's various ways. The particular way that I thought is that we should literally give a direct subsidy to financial advisors. Financial advisors who are licensed, as so that they know something, and who also sign a statement that they will not be a salesperson. In other words, they won't take commissions for steering someone toward a product. The real problem that got us into this mess, you might say, and which bothers me a lot, is that most lower income people had no one to talk to who was knowledgeable about finance except salespeople who were trying to sell them something.
And they were not required by law to explain that in some cases they were working on commission and would make more money if the person bought the mortgage, for example. I mean, are there a certain number of disclosure requirements that could be improved? For example,
well, that would be another route to forcing the realtors or the mortgage broker to disclose that they are getting commissions. But, you know, I think it's better to just create a situation where you have an advisor who is subject to penalties if he or she is caught taking commissions. It would be,
And would you want consultation with such a licensed advisor to be mandatory when you take out a mortgage?
Well, that's an interesting thought. I actually talk about that in my book. In Europe, in some European countries, in fact, it is essentially mandatory. They have what's called a civil notary, which is different from a notary public in the United States. Mm-hmm. A notary public in the United States has very little training. The notary public needs only to record a signature and knows how to operate this little stamp device.
Right.
Whereas in Europe, a notary has, for example, Germany or France, a notary has to have legal training. And the law requires that the notary reads over the contract before the signing and it interprets the contract for the people signing it. Yeah. I'm sure that this creates a tremendous opportunity for people to get out of bad contracts. It's much harder for some kind of sleazy operator who has to face a civil notary appointed by the government at the contract signing than it is in the United States.
Yeah. Okay. All right. Well, we're close to out of time. I really appreciate your coming on and all the light you've shed on this. Can I ask you a question about the current situation that's not so directly related to this, but just something I don't understand, okay?
Yeah.
And it's the following. They say that, okay, the root problem at the moment is a credit crisis, a lack of liquidity in the system as a whole.
Right.
And, okay, I'm sure that's true. What I don't understand is when you see the massive liquidation of stocks that we've seen lately, then presumably when you sell a stock, the money usually goes into a money market fund or a bank account or something and becomes available for lending. So why is it that this huge sell-off in equities does not itself amount to a healthy injection of liquidity into the system?
I don't know. It seems to me that stock prices falling just represents people's revaluation of the outlook for stocks in the future. It doesn't. There's nothing. All that happens is people wake up one morning and they say, "Uh-oh, it looks bad." So all the buy and sell offers are at a lower price. It doesn't do anything. That's all it does, is that the broker this morning, instead of hearing a price of $30 a share, is executing trades at $30 a share. The broker is executing trades at $20 a share. Money doesn't flow anywhere. There's no major flow of money.
Well, but wait. I mean, maybe I'm missing something. Yeah. But I mean, I had heard, for example, when people started to withdraw money from money market funds, they said, "Oh, that's a problem because these money market funds actually provide the service of lubricating company lending on a day-to-day, company borrowing on a day-to-day basis. And so, if money market funds dry up, we're in trouble." Well, a week or two ago, I thought to myself, this thing could drop a long way. So I sold about $10,000 of stocks in my SEP IRA. That money went, so I now had $10,000 more in money market funds. Presumably, I had increased the amount of money available for borrowing. I had injected liquidity into the system, right?
No. That's not right. All you did is you swapped with someone else. So you swapped the other side of that trade was another person like you who had the opposite opinion. So you lost a share and you gained a money market. The other guy lost a money market and got a share. So there was no change. So that's kind of terrifying. I now understand what you mean because people forget that for every buyer there's a seller, and when you sell stocks, it goes to someone else. There are millions of people going into the market today to buy. In fact, I know exactly how many because the number of shares bought is exactly equal to the number of shares sold, and it's the price that adjusts.
Right. And so the liquidity is drying up on one side of the deal and increasing on the other side. And that's okay. So much for that, Hope. for recovery. So, well, can you tell me, though, if this, you said people are talking about global depression, do you have any idea what that would be like in the modern world? I mean, it's kind of hard to imagine, if only because the pictures of the old global depression are just in such a different era technologically, and people are wearing funny clothes and stuff.
Right,
have you thought at all about what your life would be like, or say mine, for example, if we actually have a depression?
Well, the Great Depression of the 1930s was the worst economic experience in all 200-plus years of U.S. history. So let's not think that that is likely. What the Depression was, though, was a situation where for 10 years, from 1931 to 1941, the unemployment rate never fell below 14%. Mm-hmm. So typically, there was a very high, right in 33 it got up to 25%, but usually it was not so high. Something like 15, 16% was typical. Not so hard to imagine, though, because we have seen high unemployment rates in the 80s and 90s in Europe. Maybe not that high, 7, 8, 9, sometimes 10%. Uh-huh. We saw, we could easily see, I could see the unemployment rate, which is now 6.1%, getting up to 10% or more and kind of hanging there, for some years. Mm-hmm. And that will be bad, but I mean, it would be 10% of the labor force unemployed. And if confidence doesn't come back, we could be stuck in a situation like that for some years. Mm-hmm. And it's not hard to imagine. It's like what we're seeing now, a little bit worse.
Yeah. And by the way, what happens to interest rates in a depression? Do they plummet or?
Well, typically they plummet because the central banks, in our case the Fed, do everything they can to stimulate the economy. So they cut rates. And they get down to zero, and they can't cut them anymore, and then they've lost their ability to further stimulate. That's what happened to Japan. Japan had a stock market boom and a real estate boom in the 1980s. That bust. They had a terrible, long period of 15 years of declining home prices, where in the major cities they declined by a factor of 2/3. They lost 2/3 of their value. Over this period, the Bank of Japan kept cutting rates, and they got them down to zero. And they've been staying near zero for a long time, like close to a decade now. And it doesn't seem to be enough. I mean, it's not the end of the world. I mean, I could say this positively. I went to Japan recently, and I thought, looks like a perfectly nice place to me. I mean, they had nice restaurants, people are well dressed. It's just not growing. The economy is not growing. It's a little disappointing. Young people don't find the opportunities that they wish they'd find, and they have falling prices for a long time. The stock market is way down for a long time.
And the good news for consumers is that stuff gets cheaper, I guess. If you do have a job, stuff gets cheaper.
Well, it's not a great situation, and
no.
So, but I wouldn't be. It's not the end of the world. It's just a slowdown, and some people do very well in depressions. I'm hopeful that it won't be so bad, but unfortunately, it's hard to get things going now. The real problem is that confidence is shattered, and so people don't think about. In order to keep the economy vibrant, you have to have people starting businesses and hiring and borrowing money. And but when nobody trusts anything, you don't have the bank won't lend them any money. And even if the bank did, they might not want to start a business now because it seems like the whole situation is too iffy. So if everybody holds back, and an existing business, they might have been thinking about expanding their operations and building a new factory and hiring more people, but now they think, wait a minute, let's just put that on hold. Let's wait and see. So the whole economy gets put on hold. And it's very hard to fix that. Even if you cut interest rates to zero, they're not going to start a new factory, even if you cut interest rates to zero, if they think that the situation is uncertain. Yeah.
Well, I guess the first step in psychological adjustment would be to stop the kind of panic selling in the equity markets, which for my money, the value of equities have gotten low enough. And by the time this is actually viewed on Monday, people will know a lot more than you and I do right now about whether these various meetings over the weekend culminate in a way that inspires some degree of trust around the world. But I want to thank you again. The book that you've written is, again, the Subprime Solution, and it, again, comes out with timing that is just as good as the timing of your book, Irrational Exuberance, 8 years ago, and in both cases, I think, are a testament to your ability to anticipate problems, which we could use more of in the world, I guess.
Yes.
So thanks a lot.
Okay.
And good luck with the book.
Okay.
All right. Bye-bye.